Hey, right now, so I'm going to talk about why most investment financials are absolute garbage. And what this really is going to touch on is that I sell a lot of 1 to 4 units, residential investment properties, but also I own 5+ unit multifamily properties. And I just wanted to share, as a real estate broker and as an investor, things to look out for in terms of understanding the real value of that property and being able to run an APOD and be able to calculate things like cap rate when we're over 5+ units, as well as gross rent multiplier, cash on cash return, and all of the necessary financials in order to align the best offer, as well as understanding what your down payment is going to be and what types of terms and conditions of the deal make ultimate sense. So let me dig into it. About 98% of the time, when you see as advertised pro forma or projections, and keyword terms like rents should be, or rents could be, or rents need to be rents below market, what you're understanding is the income, just the rental income from that property, is already at a disadvantage. And what I've noticed is there's been a lot of errors in the financial documents that you request using an investment property addendum. Not only from things on who is paying the utilities, either the landlord, water, sewer, trash, or the tenant, gas, electric, internet, whatever it is, understanding who first is paying what, and what is the actual rent that is on a lease. There's been many investment properties that I looked that are month to month. There is no lease. Estoppel certificates have to be sent out. There's a lot of headaches, and understanding really what is that actual rental income that's coming in each month. I've had tenants tell me one thing, I've had a buyer or a seller say another, right? So it's understanding the dynamics of who's paying what utilities and who's paying what rent. Going deeper into that subject, what type of rental deposits were made? What type of pet deposits or pet fees were made? Is there pet rent, right? Is there any storage or storage rental income or separate lease agreements for land that's included with that rental property? So understanding income is huge. Next, in terms of understanding insurance, what you may be charged as an investor once you post-sale acquire that property isn't what somebody currently who has insurance at whatever aggregate level or liability level that they have chosen. So make sure to understand to call a few insurance companies to get quotes on that property and then compare it to what was given to you in context of the entire financial outlook of the property. Next, taxes. I've seen errors on taxes that have been reported on financials. You need to maybe anticipate that there might be a tax increase after acquisition if that's reassessed. So taxes can be huge. But the biggest demographic of problems that I see is in the following. Now, I had shot a video earlier about cap rates, and there's a bunch of multifamily people that got on me about projected cap rate versus market cap rate, and the professionals that come up with these numbers in commercial real estate. I get it. I'm not even going to go into that. What I'm talking about is the gross rent multiplier and what the cash flow after debt service is, and understanding what deferred maintenance is going to affect those numbers for the future. Not now, currently, the future. So if somebody wants, say, $350,000 for a property, but you go to inspect it and it needs new plumbing, electrical, roof, the list goes on, right? It is not going to be in your best interest to not anticipate those costs. So you got to understand your offer needs to reflect the deferred maintenance condition of that property at acquisition. Also, you need to understand what other types of vendors or utility providers is the landlord paying for, like landscaping or property maintenance, property management. And all of these variables, depending on who you hire, right, what quotes or bids you get, is ultimately going to affect the value of that property and your net operating income. So to summarize all of this, guys, what I'm trying to tell you is that real estate brokers investors who are trying to unload properties always try to paint the picture of something way better than it usually typically is. And as you dig deeper, and I've backed out of multiple transactions, you need to understand that the overall ability to look through these financials, ask for the right documents, and being able to put a clearer picture to what it should be and what that pro forma is going to be on that property is going to make night and day difference between you sinking or you sailing into the future. Now, what documents should you ask for? That's a good question. I typically always ask for rent roll, copies of all leases, copies of the P&L for the last 3 years, copy of the Schedule E's for the last 3 years. I ask for copies of insurance, any violations, any delinquency notices. The list goes on, guys. The list goes on. Any paperwork that has to do with well or septic, any maintenance contracts that are going to be in process or in action or in action of still being in action when I take over. And I put all of these documents together. I create a big Google folder. I organize them well. I go through each and every one, and then I run an APOD. I look at the property. I try to come up with the best valuation of that property based upon where is it currently at and where does it need to be and how is it going to get there. Okay? So putting that all together, I want you to understand some of the major components to all of this. You need to buy yourself enough time to do your due diligence. If you know you're slower on reading documents or getting professional advice from people that things you don't understand, you need to build yourself a bigger investment property due diligence period. I typically suggest at least 10 business days, depending on the size of the property and the amount of documents you're probably going to have. Also, you need to understand how big or how long you've given yourself as an inspection window in order to inspect the units, to inspect the roof, foundation, electrical systems, plumbing, any invasive inspections that you may do, like septic, main sewer lines, any of that. So putting that all together, guys, what I'm getting at is you can't judge a book by its cover. You can't look at an MLS listing or a commercial real estate listing and say to yourself, oh, this is what it's going to be. I'm going to buy it and it's going to be the exact same performance. Because ultimately, as an investor, where the biggest upside is, right, in that value add term you hear, is being able to look at its current state and then being able to create value, being able to cut costs, being able to add value or rental income, and being able to raise that net operating income and being able to pay down debt service faster or be able to return on that property or buy cash flow at a better cap rate. So all of that being said, guys, if you have any questions about due diligence, investment property addendums, what I look for, what red flags I look for, what questions I ask listing agents or commercial real estate agents, what to look for in different types of asset class, single family rental portfolios versus duplexes and 3 units and 4 units, 5-unit commercial, land, mobile home parks, reach out to me. You can call or text. Please hit the notification bell. Please subscribe to this channel. And I'd be here to always be a resource for any investor as a real estate strategist for all. Thank you, guys.